Welcome to this FinBot Insights Explainer. Today, we're diving into a fascinating matchup in the investing world, the focused power of a momentum strategy versus the broad established might of the S&P 500. You see questions like this pop up all the time in investor forums, and it really gets to the heart of a critical debate. Now, this person mentions VOO, which is one of the huge S&P 500 ETFs. For our analysis, we're going to use SPY. The original and most traded S&P 500 ETF is our stand-in, but the core question is exactly the same. Should your main holding track the whole market, or should it be a strategy designed specifically to chase performance?
So to really frame this debate properly, we have to start by establishing our benchmark. Let's talk about the established champion of passive investing, the S&P 500.
The S&P 500 is, for all intents and purposes, the gold standard for a diversified stock portfolio. Its whole purpose is to give you broad exposure to all the major sectors of the U.S. economy, which is why it's so often used as a proxy for the health of American business itself. The strategy behind an ETF like SPY is really simple, but it's also been incredibly effective over the long run. The idea is just to buy the market, enjoy its general upward trend over time, and stay nicely diversified across all kinds of industries. Okay, so that's our champion. Now let's introduce the challenger. This is a strategy built on something completely different. Not broad inclusion, but a specific, well-documented market phenomenon called the momentum factor. At its core, momentum investing is based on a simple belief. Things that have been doing well recently are likely to keep doing well in the near future. It's a concept that's really driven by investor psychology. Things like herd behavior and delayed reactions to news can cause these price trends to stick around for a while. The Invesco S&P 500 Momentum ETF, or SPMO, basically puts this strategy on autopilot. As you can see, it follows a clear process. First, it scores every stock in the S&P 500 based on how its price has changed over the last year, adjusting for how volatile it was. Then, it just picks the top 100 stocks with the best scores. And finally, it weights those stocks based on both their size and that momentum score. So it's really concentrating its bets on the strongest trends. So what's the big appeal of this challenger? Well, it really comes down to its track record, which looks especially impressive when the market is in a strong growth phase. When you put the numbers side by side, a pretty clear pattern emerges. Looking at the last 1, 3, and 5 years, SPMO has consistently posted higher annualized returns than the broad market SPY. It really showcases the potential power of its momentum-focused approach. And you can really see this potential in a strong bull market. Take 2024, for instance. SPMO's outperformance here is just stark, and it really illustrates the kind of rewards you can get from focusing only on the stocks with the strongest recent performance.
But, and this is a really big but, that potential for higher reward doesn't come for free. It is directly tied to a higher degree of risk, and it's absolutely crucial to understand this side of the coin before jumping in.
Momentum investing comes with its own unique set of risks. As prices shoot up, they can get disconnected from a company's actual underlying value, which creates what we call overvaluation risk. And what's more, these trends can reverse on a dime, leading to really sharp drops when market sentiment finally shifts. This brings us to a pretty eye-popping number. In its last fiscal year, the SPMO ETF reported a portfolio turnover rate of 72%. Just think about that for a second. That means almost 3/4 of the entire portfolio was sold and replaced within a single year.
So what does all that buying and selling actually mean for you, the investor? Well, it has direct consequences. It can lead to higher transaction costs, and perhaps more importantly, it can create a much bigger tax bill from all those frequently realized capital gains, especially if you hold it in a regular taxable account.
Now, a common criticism you'll hear about an ETF like SPMO is its concentration in just a handful of stocks. But when we look a little closer at this, it reveals a surprising vulnerability in our established champion as well. And it's true, SPMO is very concentrated. As you can see, its top 10 holdings make up almost 60% of the entire portfolio. That is substantially higher than SPY, where the top 10 account for just over 36%. So looking at that chart, you might think, okay, case closed. The S&P 500 is obviously the safer, more diversified choice. But that conclusion might be a little premature. The nature of diversification is a bit more nuanced than that. Here's the catch. Even though the S&P 500 holds 500 different stocks, because it's weighted by market cap, its performance is heavily dictated by the fate of just a few dominant mega-cap companies. This introduces its own kind of concentration risk, a fact that's often overlooked by many investors. So ultimately, the choice between these two ETFs isn't really about finding one absolute winner. It's about aligning your investment strategy with your own specific goals, your time horizon, and your personal tolerance for risk. The decision really rests on your own investment philosophy. You can think of SPY as that classic core holding, the foundation of a portfolio that's built for steady, diversified growth. SPMO, on the other hand, is more like a satellite position, something an investor with a higher risk tolerance might use to tactically try and capitalize on strong market trends. And all of this leaves us with one final big question that every single investor has to answer for themselves. There really is no single correct answer here, only the answer that's correct for your own financial journey. We hope this analysis provides some real clarity for your own investment decisions. Thanks for joining us for this FinBot Insights Explainer. To keep building your financial knowledge with us, please do click that like button and be sure to subscribe for future insights.